All right, so what's going on with the small caps? Why are we seeing so much outperformance, a multi-month win streak? Why do investors suddenly have so much confidence in small caps?
Well, I think it's always good to start with why investors would want to have small caps in the first place. They're part of the global market. They're about 10% of the United States by market capitalization. And these are not exactly mom and pop companies. In some cases, these are relatively large firms, $5-6 billion worth of market capitalization. And they also offer a diversification benefit. I know there was some consternation that was voiced earlier in this show about, all-time highs or market concentration or valuation. Well, a lot of this is large cap specific effects. So having an allocation to small caps can minimize your exposure to that. But I think really at the end of the day, the takeaway for investors is that over the long haul, small caps have tended to outpace large caps when it comes to returns, about 1.5 to 2% per year across the globe going back historically. So when I see a period of time where small caps have been outperforming large caps, that doesn't surprise me because that's my expectation based on the historical data.
All right. One of the things you say is a benefit for small caps right now is a valuation discount. Are we clear that investors really care about valuation? Again, the S&P 500 moving to a new record high, and that was without NVIDIA, and a lot of high valuation names are part of that move to the upside.
Certainly, many of the investors I've spoken to have voiced some concerns just looking at the time series of valuations. They have been increasing for U.S. large cap companies. Now, that is very specific to large cap, particularly large cap growth companies. And so if you look at small caps, their valuations are pretty closely in line with their historical averages. And so our research doesn't show that these are strongly predictive of future returns. But to the extent that investors are sensitive to that, that can be a good way to minimize your exposure.
All right. By the way, small caps trading at about 18 times forward earnings right now. When we're looking at small caps, are there certain areas of the small caps that are more attractive than others? Like maybe biotech? Is it domestic retailers? Are those more attractive right now? Like what area of the small caps? Because we often talk about it like it's just like this monolith, but it's 2,000 different stocks. And as you mentioned, it's not like they're all mom and pop shops. Some of them are very big enterprises.
Yeah, historically, there really hasn't been much of a sector dependence when it comes to small cap returns. You can measure this in different ways. Look at the performance of small versus large within sectors, or if you have sector neutral small cap strategies, they perform similarly to ones that are sector agnostic. I think to a larger extent, like you point out, there are a lot of small caps out there. And historically, what we observe is that the return of the small cap space is not driven equally by all the stocks within the space. It's usually a very small subset that deliver the return of the asset class. So absent the ability to predict which individual companies are going to outperform, and we now have about 7 decades worth of academic evidence that investors cannot consistently predict which ones are going to outperform, we believe in holding a very broadly diversified basket of these companies so that we can be holding the ones that ultimately deliver the small cap asset class return.
Hey, Wes, we'll let you go. We're showing the titles of 2 of your ETFs, the dimensional U.S. small cap ETF and the U.S. targeted ETF. How does that differ from just the IWM that just does all 2,000 stocks?
So a big part of investing in small cap space is having flexibility. And part of that is holding companies that you believe are poised to deliver higher expected returns. There's a big swath of the small cap space that has lower expected returns. These are companies with very high valuations, low profitability, very high balance sheet asset growth year over year. And our research suggests that these companies tend to underperform by substantial amounts. It could be 8 to 10% per year. And so we have a set of exclusions that we apply that I think really differ our strategies from traditional index solutions. So we can be choosier about what we hold within the small cap space to pursue higher expected returns.
Actively managed or passively managed?
It's active in the sense that we don't track an index.
Okay.
I think that when our investment philosophy really starts with a rules-based approach, which is something that's shared by both us and index funds, but then we layer on a level of flexibility.